Welcome to American Dreams. I visit here today with Eric Ball. Eric, welcome to today's program.
Thanks, Alan. It's really fun to be with you again, and I'm looking forward to catching up.
So, Eric, we've known each other for years, and as we get together today, we want to let's revisit your background and your journey through Silicon Valley and how you got to where you are today.
Oh well, sure. I'll try to make a 50-year story short. I started as an academic. I grew up in the Midwest, went to college in the Midwest, and then went straight into graduate school and started life as an academic in economics and finance. But I elected to not build a career as an academic. In 1988, I launched a 32-year corporate career where I spent the bulk of my career working for five large corporations. The last 11 of those years, from 2005 through 2015, I was a senior vice president and treasurer at Oracle, working for Larry Ellison. I was part of the senior team in finance there, borrowed $52 billion to pay for 105 acquisitions that occurred on my watch. I also managed the portfolio of corporate venture assets. Oracle acquired a lot of companies with active corporate venture programs, and we ended up with stakes in 180 different startup companies, and that was part of my charter. At the same time, I started doing investing in venture capital on the side. I had done my doctoral dissertation in venture capital, and I had gained as a mentor Don Lucas, somebody I have immense love and respect for. And he had been the first venture investor in Oracle. He was on the audit committee of the board at Oracle that sort of made him one of my bosses. And I spent a lot of time with him outside of Oracle, joining him as he made investments in early stage startup companies. So I started both of those roles at Oracle and hanging out with Don around 2005. Invested in several companies. Then in 2015, I left Oracle to join a startup, an AI unicorn here in Silicon Valley. I was CFO there for a year, and then left to launch to be part of launching Impact Venture Capital.
You know, that's quite a history there, and a lot of very successful landmarks. I'm going to circle back to Midwest. What part of the Midwest?
I grew up in Michigan, in the Detroit suburbs.
Excellent.
Yeah.
So, and you're a Michigan alumni, or?
Yeah, I went to University of Michigan. I'm a diehard Michigan alum. I've had to diversify a little bit because my oldest is a freshman at University of Wisconsin. So I'm working my allegiances around the Big Ten. But I remain a diehard Michigan alum, and my youngest, who's in eighth grade, says he wants to go to Michigan. So I may still get a chance to get a child to my alma mater.
So I want to revisit. So there's been a transition that's a very successful history with Oracle during the acquisition time. 52 billion is no small number to go out and start buying companies and then moving from there for a year to another CFO position. But what was the motivation for launching the venture firm in 2016?
Well, I had been investing in venture since 2005, and really found that I had a passion for it. And that was a little bit of a surprise to me because I spent the bulk of my career at really big companies. But I was drawn to small companies where you could make a decision to change direction on Monday and already be in that new direction on Tuesday, and that's very appealing. I also learned that even though my background was with larger companies, I had built some skills that were useful for small companies, and that I had advice for them, and some of them were interested in listening to my advice. And so the idea of engaging in a fresh opportunity, in building something from scratch, and in really feeling like I was having a meaningful influence on the path that a young company was taking. Turns out to be very addictive. I also really enjoyed essentially the portfolio approach of investing in 20 young companies, and having my own fortunes rely on a portfolio rather than a single bet on a single company. I just found it interesting to be looking at one business model on Monday and another business model on Tuesday, and I just found that really intellectually engaging and stimulating. Um, but I'd say the primary motivation was that at the time, I didn't see a lot of independent venture firms that were collaborating effectively with the large corporates. And I thought that perhaps my unusual background for a venture capitalist, which is coming out of working at very large corporates, might be useful to build an independent venture firm that itself played well with those corporates in terms of investing in young startups.
How has COVID impacted the venture community?
Um, well, I would say in a couple of different ways. The amount of dollars that the venture community allocated to startups only paused briefly. So 2019 set a record. 2020, I think, was going to break that record and ended up merely matching the 2019 record. And then 2021 just blew the record out of the water again. So the overall activity in the space in terms of dollars allocated to startups really d- barely paused and then just continued upward. Um, in terms of how it affected the startups that themselves were being funded, I think it really taught um, a mix of, you can have a plan. What Mike Tyson said: everybody has a plan till they get punched in the face. You can have a plan, and it's important to have a plan, but your ability to react becomes very important too. And so venture investing is a really strong mix of planning and reacting. We had a portfolio of companies on we had 20 companies in our fund one and 12 companies so far in our second fund. And we had essentially, some were doing well, some were doing less well, but COVID changed the dynamics of every company so much that it completely flipped who our best performing companies were. We had some companies that couldn't meet in person with customers and their sales suffered. Even though they had great business models, they just weren't meeting their sales projections. We had other companies that experienced a huge tailwind and did much better in a COVID environment. We had just invested in one company, our first company in Fund Two, that was using machine learning to create synthetic medical records to improve health outcomes and actually make medical research easier to do. And we invested in that company in January of 2020. And the Gates Foundation decided that it was one of the best companies equipped to help lead the fight against COVID. So this company had a kind of a rocket fuel accelerant to its growth. We had another company that called TaskHuman that markets to corporations to allow their employees to access, access to professionals, nurses, mental health professionals, fitness coaches, dietitians, all in a remote platform. It's like Zoom for personal improvement. And the demand for that kind of access to health professionals remotely got a clear boost from COVID. People were much more interested in getting health advice without actually traveling to a medical office to get it. So there were several companies in our portfolio that just took off because of COVID, even while other companies had trouble with sales because of COVID. And what it meant was that when we set out at the beginning of 2020 with our forecast of which companies would perform better and which would struggle, that became completely jumbled and changed over the course of COVID, and we had to simultaneously make decisions in real time about reallocating our own capital to feed the winners, including the winners that were unexpected winners that all happened under COVID. And now, as we are starting to see the first signs of emerging from COVID, we're finding ourselves with a new balanced rank ordering of which companies in our portfolio seem to be best positioned.
So you always have opportunities to decide whether or not you want to be partnering or investing in a company. What is the primary differentiating factor why you invest with one company over another?
Oh, well, that's I think that's there are different elements that go into that. As a finance person, before I got into venture, I used to think that it was primarily an analytical exercise and that, it was about, evaluating numbers and forecasts and determining which company you would forecast better cash flows. And there remains an element of that to it. But I also think there's a creative element or an intuitive element that's more like being an artist than a quant. And the younger the company, the more artistry is involved versus quant, where you really synthesize a mix of how does the market look, how does the sector look, how does the team look, how does the business model look, and you may have a forecast that undersells or oversells, and so it's a mix of business model and team and market fit, and there's a real blend of analytical and business, uh, and more just intuition and creativity that go into it, which makes it really interesting. And I think that it makes investing in very young companies a very different experience than investing in more mature companies where you have cash flows and you have more numbers to base your decisions from.
So Eric, I'm a new entrepreneur, and I got a great business plan, got a great story to tell. I want to come before you and pitch my new company and get some money. Before you're going to open that door, what are the minimum requirements that I need to have in order for you to even talk to me? Yeah, give me a little bit of coaching so I'm not wasting your time or my time.
Well, I think a lot of it, it starts with a presentation or an overview of the business and the team that strikes the right balance between being concise and being thorough. And that needs to include a description of what the opportunity is, why this team is the best team to pursue that opportunity, why this time is the best time to pursue that opportunity, how you're going to guard against downside, but most importantly, how are you going to capture upside? As a finance professional in a large company, you're usually trying to avoid a bad outcome. You're very cautious and risk averse. But as an entrepreneur, the real question is, what is the how good is the best case outcome? Because venture investors aren't looking for high probability of a little bit of return. They're looking for some probability of a very large return. And the appeal of venture is that you can gain 1,000 to 1 multiple on investment, but you can only lose 1 times your investment. And so you're looking for that asymmetric payoff. And so you do need to have a mix of business model and team and really spend time on both of those to show that it's the right team to execute against the business model that you've identified. But I always tell people, figure out what the best case outcome looks like and tell me how good things can be if the best case outcome appears. Because it's surprising how many people come with somewhat muted ambition. I think I've got a really good chance of doubling doubling the investment over several years, and that's great. And you should always strive to be credible. Um, but I might rather invest in something that has the possibility of being a very outsized outcome, even if the probability is a little bit lower. Because in a portfolio of 20 or 30 companies in a fund, I only need a couple of them to perform in an outsized way to be a well performing fund.
So, Eric, I want to probe a little bit deeper into this. As you know, I am an aspiring entrepreneur with, great business plan. Number one, coming before coming to you, do I need to have any revenue? Are you going to look at seed stage versus do you want to look at Series A?
We are early stage, so in our case, you don't have to have revenue. It's great if you do, but you don't have to. We are often the first institutional investor in a startup, which means that maybe friends and family and angel investors have already come in, but corporates may not have come in. Larger venture firms may not have come in. So we are frequently the first institutional investor. You need to have more than an idea. You need to have credible traction toward revenue, but you do not need to already have revenue.
Okay, so number two, there's a commitment made to give me money. Okay, are you going to draw accountability and gently siphon that out as we reach benchmarks, or do I get the whole thing at once with the free
Well,
reign?
well, you get an initial investment, but we, like most venture firms, will make a relatively modest initial investment. And we typically don't start investing in a company once it's mature. We only invest in companies if we're in fairly early, but we do continue investing in companies that we've already invested in if they meet their milestones. So our initial check may be small. It could be, $500,000 or some other relatively modest amount. But then, if the company uh, gets traction, meets its milestones, uh, the team sets stretch goals and is accountable for those goals and meets those goals, then we might write a larger check the second time around. And we will also then go and find people who can write a larger check still than we can, um, because much of what our role is to serve as the bridge between that's early seed capital and larger investments. And a large part of what sets us apart is our emphasis on collaborating with corporate venture arms, and we invest in companies that we think will become interesting to those corporates. Even though we may invest while they're still too small for the corporates to actually be part of the initial investment.
Very good. Okay, so Eric, what is the climate like in Silicon Valley right now? We've seen in Wall Street a recent pullback of some of the growth oriented stocks. The SPACs have a lot of them have fallen on their sword. But can you give us an overall feeling and sentiment for where innovation is at and where what the hot sectors are right now?
Well, innovation is running, at a breakneck pace, and nothing has caused that to pause. Even during COVID in 2021, the amount of venture dollars raised and allocated, increased substantially. Nearly doubled. So 2019 set a record, 2020 tied that record, and 2021 shattered that record. So when people talk about, month to month, uh, you know, acceleration or pullback, it's based on a baseline of more dollars going into venture than ever before, and that continues to be the dominant theme. Some sectors are seeing more growth both in capital and in valuations than others. Fintech, finance technology, is seeing some very high valuations, even on relatively modest revenues. Cybersecurity remains a very active space where if you have an innovative product, you are rewarded with a high valuation. Digital medicine is a very active space. The intersection of life sciences with software and hardware just has tremendous opportunity. And I think even the COVID crisis helped show what type of opportunity there is in that intersection of life sciences and hard technology. So those are just some of the sectors. We at Impact Venture Capital invest in young companies, but we look for companies that also have some kind of applied artificial intelligence um, uh, tool within their toolkit. In the 1990s, there was a lot of investment in internet tools and internet technology, and in the 2000s, those internet tools were used to make every sector more productive. Every company, manufacturing companies, food companies, all started using the internet as a productivity tool. We think that there's an equivalent uh, thing happening now with artificial intelligence, where for several years, people were pushing the frontiers of what machine learning and AI could do. And now it's become a productivity tool. And a lot of startups are taking those tools and applying them to help make multiple sectors more productive. And so we are not sector specific, but we look for the deployment of AI tools in, finance, security, health, different sectors. And we think that that can be a winning strategy today in the same way that internet productivity tools were a winning strategy 20 years ago. And then what we also see in the venture space is a validation of the decision that we made 5 years ago. We said we want to be the independent VC that collaborates well with corporates. When we started in 2016, fewer than 1 in 10 venture-backed deals included a corporate investor. In 2021, over half of the venture-backed deals included a corporate investor. So a large part of this infusion of capital and attention is coming from corporates who've realized that they need to go beyond simply acquiring young companies or doing internal R&D, but it's very cost effective to become a venture investor themselves and get access to new technologies with a relatively modest check size. And so we are investing in young companies based in large part on our discussions and partnerships with corporates around what technologies they're looking for. And we think that we get an informational advantage from doing that in a way that lets us look at young companies that either already have or might soon catch the attention of some of the larger corporates that are playing a much bigger role in the venture ecosystem than they were even just a couple of years ago.
Very good. Well, I've been visiting here today with Eric Ball. Eric, I appreciate you giving us an update with Silicon Valley, where things are at, and also your recent fund. So, Eric, if a person has questions they want to follow up with you, how would they go and reach you?
They can go to our website, impactvc.com. That's impactvc.com, and we have contact information, email addresses there, and we're always happy to hear from people who'd like to learn more about what we're doing.
Very good. Thank you.
Thank you, Alan. It's great to talk to you.